Hey guys, welcome back to Chart of the Week with Glassnode, where we break down some of the most important charts in crypto. Today, we're taking a closer look at dealer gamma exposure and why it's becoming increasingly important for navigating market volatility. This metric is directly linked to dealer hedging flows, which can significantly influence short-term price action. So first, a quick reminder. Dealer gamma exposure measures how sensitive dealer's delta is to changes in price. In simple terms, it tells us how dealers are likely to hedge as the market moves, and whether those hedging flows will amplify volatility or suppress it. When dealers are short gamma, the hedging flows amplify price moves rather than dampen them. As price goes up, they need to buy more to stay neutral. As price goes down, they need to sell. This creates flows that can accelerate breakouts or breakdowns. On the other hand, when dealers are long gamma, they sell into strengths and buy into weakness. That behavior helps stabilize price action and often leads to more range-bound conditions. These areas are sometimes referred to as gamma walls. So with that in mind, let's dive into the chart. Looking at options gamma exposure across expiries, we can clearly see that the market is sitting inside a broad short gamma corridor, stretching from 70K all the way down to 40K. The 62K level stands out in particular, with roughly 1.4 billion of negative dealer gamma. That makes it a key liquidity magnet and a structurally important level for price. So if we zoom in into the expiries, 542 millions of that negative gamma at 62K is set to expire this Friday. This makes it especially relevant in the short term, as any move lower into expiry could accelerate quickly. Further out, another large concentration rolls off at the end of March, roughly 600 millions of negative gamma at 62K and an additional 680 millions at the 60K strike. These are sizable exposures that can continue to shape price dynamics over the coming weeks. Remember, when dealers are short gamma, the hedging flows amplify price moves rather than dampen them. If Bitcoin trades lower, market maker needs to sell futures to stay delta neutral, which can reinforce downside momentum. Negative gamma doesn't dictate direction, but it increases the probability of sharp, accelerated moves once momentum starts building. With this much put exposure into expiry, the incentive structure becomes clear. Put holders benefit from downside pressure, while dealers hedging short gamma positions may be forced to add to selling via futures, reinforcing the move. Now, let's take a look at one of our latest features, the GEX Heatmap, the gamma exposure heatmap. This chart shows how dealer gamma exposure has evolved over the past 3 months, and it helps visualize where the market structure is more likely to suppress volatility, where there are green bands, or amplify it, where there are red bands. And here we have two textbook examples. First, the persistent gamma bands shown in green, right here. In December, we saw distinct horizontal green bands around 85K. These acted as classic gamma walls. Dealers were structurally long gamma at those levels, meaning they were incentivized to sell strength and buy weakness, which dampened volatility and helped pin price into a tight range. Importantly, the market didn't break that wall. The structure changed because the option expired with the last expiry of the year on the 26th of December. Once that positive gamma rolled off, the pinning effect faded, price no longer mechanically stabilized around that level, and the market was free to move, and price went up in early January. So as price moved away from that zone, dealers gradually shifted into negative gamma as new positions were built at higher levels. That brings us to the second example, the expanding negative gamma zone, here shown in red. During the January-February leg down, the heat map shifted toward deeper red bands around and below spot. In that regime, volatility expands and momentum can accelerate. So as the market continued lower, some participants began taking profit on their long gamma exposure, and that reduced the dealer's short gamma positioning. At the local bottom, right here, short gamma exposure had largely been absorbed, which helped stabilize price and allow for reflexive bounce. So that bounce then created room for traders to rebuild long gamma positions, which in turn pushed dealer back into meaningful negative gamma exposure once again. And this is where we stand right now. So this is how the heat map becomes actionable. It helps you determine whether the current structure favors volatility compression, right here, or volatility expansion, like here. And it highlights the key levels that can act as liquidity magnets. So thank you for watching Chart of the Week. If you enjoyed the video, give it a like, and we will see you next week.